Let's talk to Tim Harrison. He's the head of wealth management at Linear Investments. Very good morning to you, young Tim.
Good morning.
Right, this time last week you said it was all about macro, and for your sins, I guess this week's all about macro.
Well, I've got to say, last week, what a week. I mean, incredible moves on the markets. I was sitting there watching the TV on Monday evening, just watching the Dow plummet. And then at the blink of an eye, we've suddenly rallied 700, 800, 1,000 points higher. And yeah, I mean, incredible volatility and a lot of market commentators saying what's been the cause of it, who's been the driver behind it. Is it algorithms getting their hands on or getting their systems aggressively selling? Is it the insurance companies? There's an article in the paper today suggesting it could be their volatility funds. I noted that one of the big investment houses put their hands up and said sorry last week for the volatility. So it's a case of this morning, obviously the markets are higher. Part of that is, I suggest, the start of a relief, if you like, that the world hasn't imploded over the weekend. But again, we've got data out in the UK and in the US this week, which will point towards the argument suggesting that we are going to see more rate rises in the UK and the US than we had thought of earlier in the year.
So in terms of this week, what are the key numbers?
So we've got the retail sales on Friday in the UK. That's going to be a key figure to look out for. Also, we've got inflation data tomorrow in the United Kingdom, which again will give further clarity as to whether or not we are organically slowing down or whether or not there will be need for a rate rise. Now, the suggestion is that we are going to see inflation slightly tapered or tempered down to the 2.9% level from 3.1 where we were a few months ago. Yep. If that's the case, then that would fit quite nicely in my theme that the whole market is just working its mechanics quite handsomely and contracting us at a sensible rate. So we shouldn't need overzealous rate rises in the United Kingdom. But again, you've got the wage growth, which is falling behind, so the real incomes, etc., is a struggle. So it's a real juxtaposition for Mark Carney as to whether or not they do raise rates to quash or to quell the inflation argument, or whether or not they try to see wage growth continue to or start to increase to batten that, to counteract that. So it's a tough gig for Mark Carney at the moment. Yep. And with the markets doing what they are doing, some suggest last week was a bit of petulance from traders just slamming everything and anything, blanket selling to try and force the hand of central bankers. But as one would suggest, there isn't a lot more that the central bankers can do to get us out of trouble, unlike years ago when they introduced quantitative easing, etc., etc. Now they've already done that, so it's not a case of going back to the old hat. They've used that bullet, if you like. So it's a case of if we are going to crash, then it could get quite nasty. I don't think we are. I think we have seen an aggressive sell-off. We needed it. It's a correction, but again, the next few days, week or so, will show whether or not there is real method behind the madness or whether or not it was just a bit of a panic and we continue higher.
So finally, what are you saying to your clients?
It's a case of, as you know, we've not been fully exposed all the way up and therefore we've not been as affected by this pullback. It is a case of getting ready to start to look for real value and start to put money to work. But at the moment, we're not through the other end. I'm still cautious and I'm still tentative, so therefore it's a case of buying, starting to put exposure to work where there is a value case. A lot of stocks are overbought and rightly they have come back more aggressively than those value plays, but at the moment it's just a case of get ready because at some point if we do stabilise there will be a great buying opportunity.
Tim, thank you very much indeed.